All right. Good morning, everybody. Good morning, all you magnificent melonheads of the world. Happy Thursday, everybody. Today is July 31st, 2025. And top story this morning, we got a three-way tie for the top stories this morning. Big tech earnings beat. Powell went full hawk yesterday, and we are, of course, drinking from the proverbial fire hose of tariff and trade war news this morning. Let's start with the one that is driving markets most, those big tech earnings. It was a big beat on the top and bottom line for both Microsoft and Meta yesterday. Look, their core business is booming at both companies. Meta ad business is crushing it. Microsoft, their cloud revenue keeps growing like gangbusters. And so with those reports yesterday, both companies have renewed their license to burn investors' cash via runaway CapEx. And that's the big takeaway. What's going to happen to those CapEx numbers? That's what will determine whether this AI bubble keeps inflating or not. And well, yesterday, both companies suggested in some ways their CapEx was going to rise. They didn't quite rise absolutely. Microsoft hinted that 2026 CapEx is going to be lower than 2025, while at the same time raising their CapEx for this current quarter quite a bit. But either way, guys, the cash burn is going to continue in the short term at least. So, if you're looking for big tech earnings to pop the AI bubble, it was not last night. Definitely didn't happen. Last thing, you got to mention, beware those free cash flow numbers. Both companies are seeing declines in free cash flow. Meta has virtually wiped out their free cash flow. So there are consequences and there are limits to how long they can keep burning this cash. They're almost out of it over at Meta. But for the time being, that's not a concern for the time being. Eventually it will be, as will be the wall of depreciation that they are speeding towards right now. Both companies use bloated estimates for the useful life of these GPUs that they're buying in this data center equipment. They claim between 5.5 and 6 year useful life. They take straight line depreciation from that, meaning it depreciates evenly across that time span. That's just not accurate. This stuff is not going to last 6 years. They'll be lucky to get 3 out of it. The average H100 GPU in use today is about 1.5 years old, which means it's already about halfway through its useful life. What happens when they have to start accelerating that depreciation to account for these things dropping off? Well, that means their earnings are going to take a big hit. But again, it's not today. So in the meantime, you got $500 billion in market cap has been added to just those two names this morning. Actually, just within a few minutes of announcing their earnings yesterday, $500 billion in new market cap. Got to keep that in context, guys. That gain alone is more than the total market cap of all but 17 companies in the entire world gained in a few minutes just among those two names. Valuations just keep running. Another big one this morning, Jerome Powell, the hawk. We had the FOMC meeting yesterday, and Jay Powell came out swinging. I'll be honest with you. He struck a particularly hawkish tone. Fed left rates unchanged. No surprise there. We did have the two dissensions, as we theorized. Two people who want Jay Powell's job voted for rate cuts. But they left rates unchanged. Not a big surprise there. The surprise was Jay Powell was very non-committal on a September rate cut. Actually suggested September won't happen. And the market is now adjusting their expectations down to just 40% likelihood of a rate cut in September. Powell even teased the idea of a rate hike. Nick Timiraos asked him a question, said something about, are we looking through tariff inflation to create the rate cuts? And Powell's answer said, look, the argument could be made that we're looking through inflation by not hiking here, like suggesting there is a case to be made for higher interest rates. And you know what, guys, he's right. We got inflation this morning. I mean, that's on the docket here. Also, PCE came in higher than last month, slightly higher than expected. Inflation is moving in the wrong direction. And we're sitting here talking about rate cuts. That doesn't make sense. That's not how this works. Look, he was openly defiant to President Trump's incessant demands for rate cuts, as he should be. At the same time, President Trump needs to keep in mind here that any rate cuts by the Fed are going to be viewed as acquiescing to Trump's demands. And therefore, the louder Trump screams about this, the more he pounds on the table demanding these rate cuts. In my opinion, the less likely the Fed is to give him those rate cuts, because the Fed doesn't want to be seen as being dominated by the executive branch. So President Trump should keep his mouth shut, I guess. Good luck with that one. I mean, it's never too late to turn over a new leaf, but I don't expect that old dog to start that particular new trick anytime soon here. And not even last but not least, there's a lot going on today. Trade war updates, a ton of them. President Trump crashed the copper market yesterday. In a span of a few minutes, copper prices declined by about 20% when they announced that tariffs would be applied. 50% tariffs would be applied on semi-finished copper products like pipe and wire. However, unexpectedly, pure copper, like things like cathodes, were exempted. So the raw metal is not going to be tariffed. The semi-finished products, the things we make from the metal, will be tariffed. The market was not positioned for that. Copper tariffs had rallied like crazy since the copper tariffs were teased a few weeks ago. Everybody was rushing to get their copper into the U.S., thinking the tariffs were going to go up. And now all those traders were caught off sides. They all started liquidating all at once yesterday, and it was one of the most violent moves in a rather stable commodity that I have ever seen. That was big news yesterday. It took gold and silver down with it, by the way. Metals had a really bad day yesterday. They're down again this morning. We also got a trade deal with South Korea. 15% tariffs on imports from South Korea, along with $350 billion in investments for things like chips, batteries, and shipbuilding, as we suspected yesterday. We got 50% tariffs on Brazil. Now, this was pretty interesting. Big tariffs on Brazil. And they're blaming it on this judge and on, they're saying political witch hunts. They're prosecuting the former president who didn't want to leave office when this leftist socialist won the election. And so the cover that they're using is, because of human rights violations. That's why we're putting the tariffs on Brazil. And I guess you could make that argument, but it doesn't really hold a lot of water. Here's why they're doing it. We have a trade surplus with Brazil. All right. And all of the reasoning being given for all of these other tariffs, which are on shaky ground legally, they're all being challenged in court. And we could still have a judge just come out and say all these tariffs go away one day. But the reason they're doing that is they're saying that the trade deficit the United States is running is basically an existential threat to our economy and our well-being. Well, if that's the legal basis for the tariffs, then you can't put tariffs on a country that you have a trade surplus with. That's not how it works. So they're creating a new reason to put tariffs on Brazil. Here's the real thing that they're doing. They're going after BRICS, and they're going after BRICS hard. Yesterday, we had 25% tariffs on India, and they threatened that they could go even higher because of India buying oil from Russia. There's your B, there's your R, there's your I. We got all kinds of stuff targeting the Chinese. We still don't know how high those tariffs are going to be. There's your C. And I don't know what they're going to do to South Africa. To be honest, we don't trade that much with South Africa. We buy a lot of platinum and palladium from them. But it's pretty clear that the real reason they're going after Brazil so hard is because of BRICS. They're trying to defend the dollar and its status as world reserve currency, while simultaneously bludgeoning the dollar over the head with incessant demands for easy monetary policy. What else we got? We have 15% tariffs on EU wine and spirits. Just got announced today. They're trying a little bit of a bailout for California wine country, which has done incredibly poorly over the last couple of years. Also, the exemption for de minimis packages it's gone. So from now on, packages less than $800 will be subject to tariffs. That was like the Temu exemption. It was a big part of the taco trade when they left the exemption for de minimis packages in there. It's out of here. Tariffs are going up on small packages imported from China in particular. Meanwhile, China's worried about tracking software being put in H20 GPUs. We finally said, okay, fine, Nvidia, you can sell the GPUs to the Chinese, even though we all know you've been doing it all along anyway. But now we're going to let you do it legally. And all of a sudden, China's like, we're worried about spyware being put in the chips. Yeah, let me tell you about a little company called Huawei, by the way. Huawei's like, hey, that's my job. You can't put spyware in the chips. That's what we do to freaking everybody. And I'm just like, oh, cry me a river, G. Seriously. Like, you don't want spyware in your chips? Gee, talk to your own people about that. Ford's profits nearly wiped out by the combination of tariffs on aluminum. Remember, Ford uses aluminum frames for the F-150 pickup, so aluminum tariffs particularly potent. when it comes to food. Also, big losses continuing in electric vehicles. Remember, Ford was going to build a giant 3-row electric SUV, to save the planet. Okay, yeah, they canceled that project, which they should have done on day one, taking a big hit from that, as well as the tariffs on the aluminum. And of course, we're going to go over PCE inflation, which was higher than expected this morning. A lot of stories to get through this morning, guys. Busy morning, as we suspected it would be. How about we shrink my big melon of a head? Don't forget that like button and the subscribe button for the YouTube algorithm so you can come on back tomorrow, because we do this every day. Come have your coffee with the melon heads as we go through markets. And the S&P 500 is ripping this morning, up almost a full 0.93% in the green, 59.3 points higher, driven almost entirely by Microsoft and Meta this morning. The Dow is up a more modest 92 points, or 0.2% in the green this morning. And the NASDAQ is leading the way, ripping 318 points ahead of the opening bell, set to open at yet another all-time high, 1.36%. Again, those big tech earnings are driving markets this morning. Meanwhile, we've got the DXY, which just moments ago broke back above 100. We haven't seen that for a couple of weeks here. 100.01, up 5 basis points this morning. The dollar has been getting stronger on the back of all of these tariff announcements this morning, although the dollar is still well down from where we were earlier this year. Looking over at the bond market, we have got yields lower on the long end, a little bit higher in the middle. The 30-year Treasury at 4.881, that's down 3 basis points. The 10 years at 4.353, down 2.5 points. The 2-year at 3.939, that's actually up a fraction of 1 point. And the 1 month is down almost 1 point, 4.337. Not a lot happening in bonds this morning. But guys, keep an eye on that 10-year yield as we get closer. Midnight tonight is the deadline for the re-implementation of the Liberation Day tariffs, the 90-day pause. That's up when the clock hits 12. We all turn into little tariff pumpkins, and let's see what happens to the bond market when that happens. Remember, the whole reason for that pause was because the bond market threw a freaking fit back in April. Maybe things will go better this time. Just being optimistic. I occasionally dabble in optimism. I know it's a little out of character. Bitcoin, meanwhile, still doing a whole bunch of nothing. $118,240 is priced on Coinbase. A little bit higher than yesterday. Bitcoin sold off a little bit during the FOMC press conference yesterday, but would eventually recover those losses. Still in this consolidation pattern we've been in for a few weeks. Looking over at the commodities board, we got a lot of red this morning. Gold is actually eking out a gain, though. Spot gold, $3,309. That's higher by about $34 or 1% for gold, despite the hawkish Fed undertones yesterday. Silver getting bludgeoned once again here. Spot silver, $36.70, off by another $42 after falling more than $1 yesterday. Below $37 now, 1.14% lower. Also noteworthy, note the bigger drop here in the front month contract, $36.75. That's down even more, 98 cents. So we are seeing that exchange for physical premium slam shut here. It was over $1 a few months ago. Now we're down to just a couple of pennies. The gap between the London spot market and next month's silver in New York is closing. That is almost certainly the result of the tariff announcement that we saw yesterday involving copper. People are less inclined to start moving metal across the pond for tariff reasons, and so we're seeing that arbitrage disappear. Copper, of course, the big story. Look at copper, $4.35 for September copper futures, down 22%. Dr. Copper, right? He's supposed to reflect the health of the economy. So when he's down 22% in the blink of an eye, that I'm guessing it's not a good thing. We'll talk a little bit about that. I got an article on copper queued up in just a second here. But before that, we've got platinum lower, 4.3%, palladium lower, 2.7%, and oil is lower by almost 1% as well. Oil has been ripping this week, but still below $70, $69.36 for September WTI futures. On the subject of commodities, let's take a look here at the copper story. Trump just crashed the copper market. The president unveiled a 50% tariff on copper products, but not on the raw material itself. U.S. copper futures plunged roughly 20% in late trading Wednesday after President Trump unveiled 50% tariffs on copper products, but not on the raw material itself. And it is the latest example of how Trump's gyrating trade policies have whipsawed financial markets. And Wednesday after-hours drop holds through Thursday's session. It would mark copper's biggest daily decline in records, going all the way back to 1968, exceeding even the 12% tumble that was seen on October 20th, 1987, what was known as Black Monday, when panic sent markets crashing. Copper prices had surged to records and well above global prices this month after Trump said he would impose a 50% import tax on the metal, which is used to make electronics and automobiles, and in construction, where it's used to convey water and pipes and electricity and wires. Traders and businesses raced to bring copper across the border ahead of the tariffs and filled metals warehouses in Baltimore, New Orleans, Detroit, and other storage hubs. On Wednesday, after the August 1st effective date, the White House backed off taxing copper in its less processed forms, such as concentrate and cathodes, as well as scrap, and instead slapped the levy on copper products such as wire, tubing, and sheeting. The 50% levy will also apply to copper content and other products such as pipe fittings, electrical wiring, and other components, but not the entire value of the product. According to a fact sheet from the White House, the copper tariff won't be added to levies on automobiles. So why did he do this? Is this another taco? I mentioned this on Twitter yesterday. I don't think this is a taco. He's telling us what the goal of this tariff is. He's taxing the finished copper products, or the near finished products, the pipe and the wire, but not the metal itself. What he's saying is he wants to make things like pipe or wire here in the United States. He wants copper smelters, people making these products here. And if you want to start making copper products here, then the last thing you want to do is tax the input to making those products. You don't want to tax the raw metal if you want to start manufacturing pipe and wire. All right. So what Trump did yesterday, he kind of screwed the copper miners. He kind of screwed the copper refiners, but he gave a big boost to manufacturers of copper products because their competition will get more expensive, but their input cost will not be going up. So it's a little bit about focus on where in the supply chain is he really trying to target. Then it starts to make a little bit of sense. Emphasis on a little bit of sense. All right. Meanwhile, we've got tariff effects on inflation still need to be seen, Powell says. We had a very hawkish Jerome Powell yesterday. He was openly defiant to Trump without getting overtly political, which he can't do, but he got as political as humanly possible, you could argue. The Fed can keep the interest rate steady while waiting to see if tariff policy pushes up inflation, Powell said. Higher tariffs have begun to show through more clearly to the prices of some goods, but their overall effects on economic activity and inflation remain to be seen, Powell said. He said a reasonable base case could be that effects to inflation will be short-lived, but he also cautioned that levies could cause inflationary changes that are more persistent. So what he's alluding to here is the debate. Will tariffs be a singular step change higher in prices, where the prices go up and then they stay there? Or will tariffs reignite inflation fears, where prices go up and then they keep going up? That's the big debate. Will we get that step change in inflation, or will we get that, sustained inflationary impulse? There's a lot of people out there making the case that tariffs are going to be disinflationary or deflationary because higher prices discourage consumption and they're ultimately destructive. And therefore, we could see prices move lower. Either way, we got to wait and see. We don't have that data yet. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. For the time being, we're well positioned to learn more about the likely course of the economy and the evolving balance of risks before adjusting our policy stance. We see our current policy stance as appropriate to guard against inflation risks. Even though inflation remains above their arbitrary 2% target, it has been for 60-something consecutive months, still showing no signs of going below that, and yet they're already talking about rate cuts. By the way, Powell did not commit to a September rate cut. He actually teased the possibility of even hiking rates. He's not going to hike rates, but it's possible. And look at this. This is the CME's Fed Watch tool. The likelihood of what the Fed's target rate will be after the September FOMC meeting. Right now, there's a 61% chance that the Fed does nothing in September. Only a 39% chance of a rate hike in September. So right now, the Fed is hawkish, and they appear set to plant their feet. Fast forward to December, the market is pricing in the likelihood of just one rate cut between now and the end of the year. That is a very hawkish shift in expectations for the Fed. It should be putting downward pressure on asset prices, but right now that is being overridden entirely by the big tech earnings, which is next in the queue. Meta and Microsoft keep their license to spend. And you know what? There's a million different articles about Meta and Microsoft earnings. I could talk about it all day. This headline in the Wall Street Journal beautifully captures the brutal simplicity of it. They can keep spending. The AI bubble did not pop last night. Strong performance of core businesses gives cover to blow out AI investments for now. Meta and Microsoft are both showing that obscene spending on new business can work as long as the older ones are humming. That was hardly a given heading into their latest quarterly reports on Wednesday. Meta stock price in particular had slumped nearly 6% over the past month following a flurry of news reports about CEO Mark Zuckerberg lavishing 9-figure paydays on AI researchers. And both Meta and Microsoft were already on track to spend more than 30% of this year's revenue on capital expenditures, compared with about 15 to 20% historically. Those outlays were already beginning to look like mere table stakes after Google parent Alphabet used its report last week to bump up its own CapEx spending plans for this year to $85 billion. That's more than the annual revenue generated by 92% of the companies in the S&P 500. Investors have begun to worry about the ultimate utility of such blowout spending, especially with growing global economic uncertainty hanging over Microsoft's enterprise software and Meta's social network advertising. But that didn't trip up either one in the June-ended quarter. Meta's revenue jumped 22% year over year to $47.5 billion and beat Wall Street's targets by the widest margin in more than 4 years, according to data from FactSet. Microsoft, meanwhile, got a surprisingly strong boost from its cloud operations, as well as elevated PC shipments driven by the stocking up of inventories ahead of tariffs. The company also finally disclosed the actual size of its Azure public cloud business, reporting the unit's annual revenue has surpassed the $75 billion mark. Both stocks jumped in after-hours trading, putting Microsoft's market cap in line to break above the $4 trillion mark, and Meta not far behind. They're not far from $2 trillion. Will the good times hold? Well, they better. Both stocks are trading at sharply elevated multiples of forward earnings compared with 3 years ago when the launch of ChatGPT sparked an AI gold rush. Most of the actual rewards so far have accrued to Nvidia, whose revenue has jumped tenfold since ChatGPT's launch, with its market cap crossing the $4 trillion mark earlier this month. And guys, that is the big takeaway. They made enough money to keep burning even more money. That's the takeaway. Look at Microsoft, up 8.25% ahead of the opening bell, $42 higher, $559.59 per share. That is above a $4 trillion market cap. Meanwhile, Meta just blowing it out of the water here. $773 ahead of the open, up 11.3%. They are set to open nearly at a $2 trillion market cap. Again, combined, these two companies, just the value they have added since earnings were announced last night is more than the total value of all but 17 companies in the whole freaking planet, added in the blink of an eye. Bubble does not pop today, folks. All right, let's talk about the trade deals. There is a lot of trade talk today. We're going to have to go fast. Trump says the U.S. will set a 15% tariff on South Korean imports under a new deal. I kind of figured the South Koreans were going to get a better deal than most of the other countries out there because the South Koreans have something we desperately need, and that is shipbuilding. South Korea agrees to invest $350 billion in U.S. projects. President Donald Trump said on Wednesday the U.S. will charge a 15% tariff on imports from South Korea, down from a threatened 25%, as part of a deal that eases tensions with a top 10 trading partner and key Asian ally. South Korea also agreed to invest $350 billion in the United States in projects selected by Trump and to purchase energy products worth $100 billion. They were probably going to buy most of that energy from us anyway. Maybe they're going to buy a little bit more U.S. LNG and oil versus Middle Eastern oil. That's not so much a function of the trade deal, though. It helps, but it's not huge. Let's see. South Korea seems to have avoided the worst, agreed Chung In-kyo, former South Korean trade minister. But he also said opinions about the deal could change if the $350 billion was not well spent. It was not clear what the investments would involve, where the financing would come from, or over what time frame the deals would be implemented and to what extent their terms would be binding. Trump said additional South Korean investments would be announced later. Of the total, $150 billion is aimed at a shipbuilding partnership. That's something we desperately need. As mentioned earlier, South Korea is the world's #2 shipbuilder behind China, who is absolutely eating our lunch in shipbuilding. That's not a good thing if you're planning on getting into a naval conflict with them. While $200 billion would also include chips, nuclear power, batteries, and biotechnology, Kim Yong-byun, the South Korean president's office policy chief, told a briefing. Now, we're seeing some things in there, chips and batteries, all right? Those are two things. We talked about this earlier this week with some deals that Tesla had announced to have Samsung build their chips in Texas. And then also Tesla announced they were buying some battery materials from LG yesterday. And I suspected those would probably be rolled into a trade deal with the South Koreans. You kind of have it there this morning. But the big one there is shipbuilding. We really need to get that ball rolling in this country like yesterday. Meanwhile, Trump hits Brazil with tariffs and sanctions, but key sectors were excluded. I guess it could have been a lot worse, but 50% tariffs, pretty freaking high for Brazil. U.S. President Donald Trump on Wednesday slapped a 50% tariff on most Brazilian goods to fight what he called a witch hunt against former President Jair Bolsonaro, but softened the blow by excluding sectors such as aircraft, energy, and orange juice from heavier levies. That's the big thing there, those exemptions. They're some of the biggest sectors in Brazil. So that 50% tariff rate, when you factor in those exemptions, it brings the overall tariff being paid for Brazilian imports down to something that averages closer to about 30%. But Trump announced that tariffs, some of the steepest levied on any economy in the U.S. trade war, as his administration also unveiled sanctions on the Brazilian Supreme Court justice who have been overseeing Bolsonaro's trial on charges of plotting a coup. What else do we have down here? Trump's executive order formalizing a 50% tariff excluded dozens of key Brazilian exports to the United States, including civil aircraft, pig iron, precious metals, wood pulp, energy, and fertilizers. By the way, that precious metals exemption there may have something to do with the fact that those exchange for physical premiums are collapsing in gold and silver this morning, in particular in silver. So Brazil getting hit pretty hard here while South Korea is getting the kid glove treatment. We also got this one. This was a little unexpected here. EU wine and spirits to face a 15% U.S. tariff from August 1st, the EU says. I won't spend too much time on this one, guys. Tariffs on wine and spirits were 10%. They're going up to 15%. This is after the trade deal that was signed with the EU earlier this week, or I guess this is in addition to or on top of that trade deal. Look, the wine industry has been in big trouble. People aren't eating out as much, and therefore they're drinking less wine at restaurants. Alcohol consumption as a whole is way down in the United States, and the vineyards in particular in California are really hurting by this downturn. So this tariffs on European wine and spirits is meant to give them at least a little bit of a lifeline. I don't know if it's going to be enough to bail out some of these struggling vineyards, but it looks like the fancy European booze is going to get a little bit more pricey. And this one will probably have a much bigger impact on China and on e-commerce. U.S. ends tariff exemption for all low-value packages. The de minimis tariff exemption is going away. The United States is suspending a de minimis exemption that allowed low-value commercial shipments to be shipped to the United States without facing tariffs, the White House said on Wednesday. Under an executive order signed by President Trump, packages valued at or under $800 sent to the U.S. outside of the International Postal Network will now face all applicable duties on August 29th, the White House said. Goods shipped through the postal system will face one of two tariffs, either an ad valorem duty equal to the effective tax rate on the package's country of origin, or for 6 months, a specific tariff of $80 to $200, depending on the country of origin's tariff rate. So, the small packages from Wish.com, from Temu, that kind of stuff, you're going to have to pay the tariffs. Honestly, like if the goal has always been to reshore manufacturing, then exempting all that cheap plastic Chinese crap from the tariffs was always kind of counterproductive. So I'm not terribly surprised to see this one going away. They had also put provisions in the One Big Beautiful bill to, over time, phase out the de minimis exemption, but that wasn't supposed to start until a few years from now. And I guess they're just like, no, I'm not going to wait. Instead, let's just get rid of it today. And so there you go, de minimis packages. It's out of here. Meanwhile, China summons Nvidia over H20 chip security days after U.S. talks. Oh, isn't this just adorable? China doesn't want spyware put in American chips. Freaking gag me with that noise. Like everything that Huawei has shipped into this country for the last few years is reporting back to China, including the stuff that's running our power grid, by the way. So we got that going for us. Chinese authorities summoned Nvidia to discuss alleged security risks related to its H20 chips, casting doubt over the domestic business of the world's most valuable company weeks after co-founder Jensen Huang met senior officials in Beijing. The Cyberspace Administration of China called company representatives into a meeting to discuss what it deemed serious security vulnerabilities with the artificial intelligence chip. In a statement, the internet watchdog cited comments by U.S. lawmakers about the need to install tracking capabilities into advanced chips sold to other countries. The agency asked staff to explain potential risks and provide documents as needed, the CAC said without elaborating. I would explain the potential risks as, hey, you know all that shit you've been doing to us for 20 years? Well, we might do that to you. Boo-hoo, Crimea River. The CAC's scrutiny over H20 security risks could further erode Nvidia's Chinese market share amid rising domestic competition, and immediate H20 sales resumption may face delays due to regulatory uncertainties, Forrester's principal analyst Charlie Dye said. It also aligns with China's broader push to accelerate domestic semiconductor alternatives for technological self-reliance amid U.S. export controls. In addition, the timing amplifies China's leverage in U.S. ongoing trade talks. I don't really see how that gives them much leverage in trade talks, but I digress. Look, this story, not enough to dethrone Nvidia, not this morning after that big bump up in CapEx from Microsoft and Meta. That's having a bigger impact on Nvidia's earnings versus this story. And I'm waiting for the quote to update because Nvidia stock is, oh, come on, give me my Nvidia quote already. Yahoo Finance doesn't want to play nice in the sandbox this morning. Come on, girl, you can do it. Give me an Nvidia quote. All right, well, it seems Yahoo Finance is a little camera shy this morning. Nvidia stock was up, I believe, about 2.5%, 3% on the back of those earnings reports. We must move on. It's a live show. We don't have time for websites that don't want to cooperate. Ford reports a net loss of $36 million in the second quarter of 2025. It seems those aluminum tariffs wiped out all of Ford's profits. Wait, I thought tariffs were supposed to help American manufacturers. Whoops. That one kind of shot ourselves in the foot here. Ford has disclosed its financial outcomes for the second quarter of 2025, revealing a net loss of $36 million, mainly due to special charges and electric vehicle program cancellation costs. For the second quarter, Ford reported total revenue of $50.2 billion, a 5% increase from the second quarter of 2024. Despite this, the company's adjusted earnings before interest and taxes stood at $2.14 billion, with $800 billion in adverse tariff-related impacts. Ford noted that looking ahead, it has adjusted its full year 2025 outlook, now expecting adjusted EBIT of $6.5 to $7.5 billion, including about $2 billion in net tariff-related headwinds, and aims to generate $3.5 to $4.5 billion in adjusted free cash flow. Look, this is aluminum tariffs. Ford is the only manufacturer, the only big pickup manufacturer that uses aluminum in the frames for the F-150. All the other ones are made out of steel. So those aluminum tariffs, a particularly potent charge for Ford. On top of that, Ford, you may recall from a few months ago, we announced that they were canceling their 3-row electric SUV, which is just the dumbest vehicle. That's a testament to how stupid the electric vehicle story got. The whole reason people buy electric vehicles or want to drive electric vehicles is so they can be like, look at me, I'm helping the planet. It's not to save money. Electric vehicles aren't any cheaper to drive than gasoline is when you account the cost of electricity, which is skyrocketing, by the way, because of freaking data center buildouts. But like if you're driving an electric vehicle to save the planet, maybe don't make it a 50,000-ton 3-row pig of an SUV. Seems a little counterproductive. So, of course, Ford eventually realized what a stupid idea that was. They canceled the project, took a big hit in the quarter related to that one. Ford stock down 1.9%. I'd hit refresh, but I don't know. Yahoo Finance probably doesn't want to even refresh that for me today. Ford stock was down ahead of the opening bell. And yeah, we're doing that again. Sorry, we're not playing that game. Ford not having a good day today. All right. Let's also talk about PCE inflation, because we had a lot of inflation talk in the Fed yesterday. Everybody was like, tariffs are starting to show through in some goods inflation. Well, I guess there was a little bit of truth to that. We got the PCE price, personal consumption expenditures for the month of June. This is the Fed's preferred measure of inflation. PCE came in at 2.6% year over year. That is up from 2.4% in May and 2.2% in April. Is that tariffs? That's hard to say, but inflation is trending in the wrong direction here. And so, hey, you know, if the Fed's not going to cut because inflation isn't fully vanquished, there's the data supporting it. It's still well above the arbitrary 2% target. On a month-over-month basis, same story. Headline PCE 0.3% month over month. That is up from 0.2 in May, up from 0.1 in April, and up from nothing in March. So we got 3 consecutive monthly increases in month-over-month PCE inflation. Now, what about core inflation, which strips out food and energy, because that's what poor people spend almost all of their money on, along with housing? Core PCE, 2.8%, unchanged from the prior month, but I would add that the market was actually expecting 2.7%. So this was a little bit higher than expectations, even though it's unchanged. And on a month-over-month basis, core inflation increased to 0.3%. That is up from 0.2 in May and 0.1 in April. So this is, I would say, a miss high for PCE inflation. It's not a death sentence. It's not a huge miss high. But when people are already hurting from the inflation that already happened, which the Federal Reserve told us wasn't going to happen because it was supposed to be transitory, we don't really have a lot of tolerance for this. And cutting interest rates is probably the last thing in the world you want to be doing, unless your goal is to just continuously inflate asset prices into bubble territories and beyond, in which case, go ahead, cut rates, print money, Zerp and Burr, your little heart's desire. But for now, Fed's doing nothing. And in my opinion, that is the right call, regardless of what the politicians are screaming about, depending on their particular side of the aisle. Told you guys we had a lot of news to get to today. It was a loaded morning. I just want to say thank you very much to my buddy Alex, who is sending a whole bunch of melon head, melon head emojis this morning. Thank you, Alex, for supporting the channel. I appreciate that very much. Appreciate everything you do, brother. Thanks for helping me out with that thing yesterday as well, sir. Appreciate that. Ed C., what's going on, Ed? Thank you for being a Melonhead member for 5 months. He says, is Janet stocking up on European wine? Well, let's see. Secretary Yellen, give me your thoughts on European wine in the context of the tariffs. Well, I just want to say, Jack, that I'm not so worried about tariffs on European wine. I'm much more worried about tariffs on Chinese mushrooms and Japanese mushrooms, because if there's one thing I love to do as Secretary of the Treasury, it was trip balls while doing commerce work with the delegates of other nations and our largest trading partners. And now that I'm done hallucinating on magic mushrooms, stay in character, Jack. Now that I'm done hallucinating on magic mushrooms, I'm free to talk about how unprofessional my replacement is behaving. Isn't that just great? So I'm not so worried about the European wine tariffs. Well, Secretary Yellen, as always, I thank you for your candor. You know, we get a side of Janet that you just don't get elsewhere. She opens up to me. We learn about what really ticks in the former secretary and the former Fed chair's brain. She just loves those magic mushrooms, man. You know, I don't know. It's the colors. I don't know what to tell you. Thank you very much, Ed C., for supporting the channel and for queuing up my Janet this morning. Appreciate that, brother. Alex L. is back again. He gifted 10 Nobody Special Finance memberships. Thank you so much, Alex. Appreciate doing that. And by the way, all you new Melonheads, welcome to the Melonheads. Just a reminder, guys, when you are gifted one of those memberships, you get a free super chat every month. So if you use that, I will read and respond to your questions live on the stream. And be sure and say thank you to Alex in the comments. Alex, that was very nice of you, sir. Thank you once again for everything you do for the channel. And guys, thank you very much for having your coffee with the Melonheads this morning. We got more big tech earnings this morning, and we got the non-farm payrolls tomorrow. So it's going to be another busy show tomorrow, a very impactful show. So come on back tomorrow morning. In the meantime, don't forget that like button and the subscribe button. for the YouTube algorithm, should you feel so inclined. And thank you guys so much for the super chats. Thank you to my magnanimous melon heads on YouTube and Patreon for supporting the channel. Links down below should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. Everybody, till next time, live small and dream big.